Open up your broker's options chain, and you'll notice a massive spread in pricing. You might see one call option trading for $1.50, while another on the same stock costs $8. When you're new to trading, it's easy to look at those two numbers and make a dangerous assumption. You see the lower price and assume it's the better deal. But evaluating a contract solely by its dollar amount ignores why the market priced it that way to begin with. That premium is the market's collective answer to one specific question: how likely is this option to be profitable, and by how much? It is a calculated negotiation between every buyer and seller in the market. Understanding the mechanics behind that calculation is what allows a trader to distinguish between a cheap contract and an expensive one. Once you can deconstruct the price, you stop guessing and start measuring. To understand that price, we use a foundational equation: premium equals intrinsic value plus time value. Every option, no matter how complex, is built from these two components. Intrinsic value is the real, immediate worth of the contract. If you exercise the option right now, this is the amount you would gain. Because it represents tangible value, it only exists for in-the-money options. Time value is what you pay for future possibility. Think of it like a flexible airline ticket. You aren't paying for the seat itself, that's the intrinsic value. You're paying for the flexibility to change your mind before the flight. As the departure date approaches, that flexibility loses its value, until at expiration it hits zero. Every trade is a balance between these two: the contract's actual value at this second, and the premium you are willing to pay for what might happen before the clock runs out. 6 factors determine premiums. Interest rates and dividends have minor daily impacts. The most significant driver is moneyness, the relationship between stock and strike price, which determines intrinsic value. A $10 difference between a $195 stock and $185 strike is the premium's bedrock. Next is time to expiration. This sets the baseline for time value. The more time you buy, the more opportunity you are paying for, which is why a 60-day option will always cost more than a 7-day option on the same stock. Moneyness and time are predictable, but they cannot explain why an option's price can double overnight, even if the stock price hasn't moved at all. That sudden shift is driven by implied volatility, or IV. This is the market's expectation of future movement, and it acts as the primary driver of time value. Think of IV as a weather forecast for turbulence. A flight over flat land in summer is easily insured because conditions are predictable, but a flight into a winter storm over the Rockies costs more to insure because the risk of a sudden move is much higher. The options market charges a higher premium whenever it expects weather, like earnings or economic reports. In a calm market with 15% IV, a call costs $2.50. If IV spikes to 70%, it jumps to $9. We compare this implied volatility to historical volatility. When implied is significantly higher, the inflated premium gives a mathematical edge to the seller. If you ignore these volatility levels, you can be right about the stock's direction, but still lose money because you overpaid for the expected movement. Professional traders use a systematic checklist to evaluate these premiums before every entry. Step 1 is checking IV rank to see if current volatility is high or low relative to the last year. Step 2 is comparing that IV to historical volatility to ensure you aren't buying into an artificially inflated price tag. Step 3 is verifying you have enough time for the trade to work, generally 30 to 60 days. Step 4 is checking moneyness to avoid deep out-of-the-money contracts, which are cheap because they have a very low probability of success. Finally, Step 5, calculate the break-even. You have to ask if it's realistic for the stock to reach that price before the clock runs out. Using this checklist standardizes your decision-making. It acts as a filter that helps prevent you from overpaying for a position just because the stock price seems to be moving in your favor. One major trap for beginners is focusing on the dollar price instead of the percentage. A 50-cent option on a $10 stock represents 5% of the stock's value. On a $500 stock, that same 50 cents is only a fraction of a percent. Context is what determines if a premium is actually a bargain. Then there is IV crush. This happens when buying a premium right before an event like earnings. Once news is out, uncertainty vanishes and implied volatility collapses. Even if the stock moves your way, the IV drop can wipe out the premium. A final trap is assuming all 30-day options are the same. A 30-day option with 80% IV carries vastly different risks than one with 20% IV. You now have the tools to deconstruct why an option costs what it costs today. But to understand how that price will change as the market moves, we need to look at the Greeks. In the next video, we'll break down delta, gamma, theta, and vega.